The S&P and the Nasdaq hitting new highs yet again as investors wait for key inflation data later this week. Joining us now, Anastasia Amoroso, the iCapital Chief Investment Strategist. Anastasia, great to have you with us. It sounds like you think we're setting up for some sort of a disappointment, that there's just a disconnect in terms of earning expectations and where we are at record highs.
I do. I think there's some ingredients that are definitely coming together for some market pullback and consolidation. And the reason I say that, I think there's this disconnect that is building right now between the economy that is clearly slowing and earnings expectations that are quite lofty. And so if you look at the economy, for example, whether you look at the Citi Surprise Index or the Bloomberg Surprise Index, that is now deeply in negative territory and has been trending lower for the last number of months. And the Atlanta Fed is about 1.7%, 1.5%, I should say, down from 4% that it was in the beginning of the quarter or second quarter. So I think there's a slowing momentum to the economy, and yet you compare and contrast that to the earnings expectations, and they've done nothing but move higher. And for this quarter, the second quarter in particular, they moved lower just a touch, much less than they typically do, which is 3 or 4% downward revision. So that's why, you look at this setup and you also look at this, what I call extreme market comfort with this Goldilocks scenario. Volatility is low, everybody's in the trade, and that's what it's giving me a little bit of discomfort here.
So you think earnings season is going to play out and perhaps companies will either miss expectations or severely lower guidance for the rest of the year, and then we're going to have to sort of come to grips with the fact that it's hitting, the slowing economy is hitting?
I think the initial reaction may be that we're not going to get quite as much of a surprise as we typically get in the prior quarter. So if the surprise was 7 or 8%, and that's why we've outperformed expectations the last few quarters, that's probably not going to be the case this quarter, because we've cut down earnings expectations by 0.5%. And I will say there's this bifurcation where the tech trade is still very much alive and well, and the earnings have been revised up, and everything else has been guided down. So maybe you can argue that we've already reset the bar lower for cyclicals, but I think probably not quite as much. So I think the first reaction is going to be not quite as positive earnings surprises.
When you look at the markets and you get various data points, you see how stocks are trading, you see guidance companies are giving, what concerns you the most? And, we were talking yesterday night on Fast Money about sort of the implosion that we've seen in fast food stocks, just sort of as a microcosm of how the consumer is feeling. We've seen real reversals in how these stocks are trading. The consumer's really pushing back. And you take a look at the various data points in terms of household incomes. It's not just McDonald's, it's all the way up through Chipotle has reversed. We're seeing Nike, some of the more aspirational trades, Lululemon. Are you worried about the consumer? Because the market structure is such that you just need tech to work, really.
Yes, and that's what's been working for the last couple of months, and the stock market has been able to push all new highs. But it's interesting. If you look at the equal weight S&P, it's definitely stalled out. If you look at consumer finance stocks, for example, they've also stalled out. Look, broadly speaking, I'm not overly worried about the consumer because where the unemployment rate is and where the aggregate household net worth is. But it's hard to deny that there's definitely cracks that are starting to emerge. And for example, if you look at the delinquency rates, especially for consumer finance companies that are catering to the lower income cohort, you're starting to see those delinquency rates rise. And we shouldn't completely dismiss the rise in unemployment rate, because half of the rise of the unemployment rate can be explained by layoffs. So that's clearly affecting some part of the consumer as well. So I think it's a risk that bears watching. But Melissa, from my perspective, I think the biggest risk is the headline risk around the election. And I think that rhetoric is likely to pick up, and volatility typically does pick up into the November election. Volatility
doesn't necessarily mean, though, a pullback. Are you thinking that we're setting up for some sort of, seeing that we are at record highs right now?
Yeah. Well, I think this time around, they could coincide. We should likely see a spike in volatility. Again, that's what history suggests. But I do think there's some potential for consolidation in the tech trade as well. And, I don't have to remind everybody, but there's a lot at stake in this election, whether it's taxes, whether it's tariffs, whether it's export controls. And when you think about the sector that is likely to be vulnerable to a lot of that rhetoric, it's actually the tech sector. Because remember, tech was the largest beneficiary of the tax cuts that we saw under the Trump presidency. And that's what's at stake for 2025, is whether that sunsets or not. If you think about tariffs and restrictions, those are likely to hit some of the more internationally exposed stocks. And once again, that's the tech trade. So I do think that the trade for the next few months can be consolidation, pullback in tech, and the move towards the defensives. So that's what I would be thinking about in portfolios.
Luckily, volatility is very low right now. so you can protect your portfolio
you can.
pretty cheaply.
You can. You can certainly buy downside protection. You could do that in derivatives outright. You could do that in structured investments. Or you could just trim a little bit of tech and add to things like utilities.